Nowadays, both the mainstream media and your neighbor are freaking out about a potential recession. Businesses are shutting down, unemployment rate is increasing. Yet, while the weekends are being shaken out of the market, there are also a lot of opportunities that not many are talking about. Recessions are painful and disturbing events, but the bounces back have always been more powerful. So hit the subscribe button and let's start. As defined by NBER, the National Bureau of Economic Research, a recession means a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production and wholesale retail sales. You may also have heard the term depression. A depression is a deeper, longer-lasting recession. The best documented example is the Great Depression in the 1930s, which lasted a few years and implied an unemployment rate of up to 25%. But why are recessions happening? And can they be forecasted? The economy works in cycles. While it's impossible to explain the whole economic machinery in one video, what is important is that the economy as a whole keeps going and growing. More and more countries are escaping poverty, and the already developed ones keep increasing their living standards. But this growth is not linear, although there is always a tendency to return to the mean. This is mainly caused by human psychology and people's inability to properly value things. The market as a whole is governed by two emotions, fear and greed. People tend to either be overly bearish when the market goes down or overly bullish when the market goes up. When the economy is flourishing, people and companies tend to be overconfident, which results in over-evaluating everything around them, be it a stock, a house, a car, or relying too much on a company or the credit card. This over-evaluation inevitably leads to overspending, which further results in the creation of bubbles. It's hard to resist spending money when there is nothing inside that makes the next year appear any less greater. When things get shaky, people tend to exaggerate again. The previous overspending led to a lack of liquidity, and this turns during unstable times into massive selling on the stock market and in cutting off the spendings, which will further sustain the downward spiral. In such scenarios, the economy is shifting temporarily from an inflationary one, based on spending, to a deflationary one, where nobody is spending cash. For a short period, at the very beginning of a recession, cash is king. With everything crashing today, you think you can always buy more tomorrow. So why would you spend anything today anyway? This sort of behavior is what causes a lack of liquidity in the market. It's the lack of liquidity that makes governments around the world step in to help the economy. And how do they do this? Mostly through aggressive monetary policies, including quantitative easing, or injecting new fiat money in the market to sustain stimulus packages, tax cuts, or to finance companies, or by cutting the interest rate to as little as 0%, which will stimulate the banks to take new loans. While this has short-term advantages, it can be regarded as a hidden tax paid by the regular people. More liquidity means that the money they already have is worth less. This is the moment when the economy shifts slowly back to an inflationary one. Side note here. While sometimes the economy encounters black swan events, like the 2020 pandemic, these events are not shifting the overall trend cycle. They just act as a catalyst by speeding things up. If it wasn't the virus in 2020, a recession would still have happened maybe this year or in 1 or 5 years from now. And then the obvious question is, can a recession be forecasted? Let's return to the market's emotional states. Precisely forecasting a recession is impossible. The moment analysts and mainstream media start talking about a potential recession, the market already reacts by changing its behavior, and the recession is therefore delayed. This was the case between 2016 and 2019, when a lot of analysts stood out and announced that the recession was imminent. We won't cover all indicators here, there are however two particularly interesting ones. Minimum values for the unemployment rate. While this is not necessarily a bad thing, bottom levels can indicate that the market is overconfident on the state of the economy. an upper sloping trend after a bottom, can suggest that the market is heading to a recession, and usually sudden spikes do not occur without one. Inverted yield curve. This graph shows the relation between interest rates of the long-term bonds versus the short-term ones. When the long-term bonds have a lower interest rate, then the yield curve is inverted. This occurs when the investors are willing to accept lower rates for a long-term investment in bonds in order to increase the safety of their portfolio. This shift usually occurs 1-2 years before a recession starts, but again, it does not mean a recession will always follow. As for the overall economy, these indexes are also cyclic. But how long are these cycles? Looking back in history, based on data from 1950s until today, the average length is 67 months for an expansion period and 11 months for a recession, averaging around 7 years for a full cycle. The most interesting aspect about a cycle is, however, not the length, but the changes in the GDP growth. Historically, for the same period, a recession accounted for -1.8% reduction, while a bull market brought in 24.3% gains in GDP. For many people taken by surprise by a recession, the losses are often amplified by not understanding it, which triggers a downward spiral that will compound further mistakes. So, how to handle a recession? Actually, preparing for a recession should be no different than preparing for any other event that might result in losing your income or a part of it for a period of time. While the amount depends on where you live, what monthly expenses you have, or whether you have children or not, and this just to name a few, the golden rule is to have enough money set aside to survive for at least a 6-month period without touching other funds. We will cover this topic in a separate video, but for now it is important that you do not touch your retirement funds, stocks or bonds portfolio or any other investments. The second thing to do is to cut your expenses if you haven't already. Markets are unpredictable in times of a recession, and while they can recover unexpectedly, usually that's not the case, and the crash lasts longer than the majority expects and longer than the time the majority can stay liquid. The third thing to do is to start investing. And this is by no means going all in or trying to guess the bottom for the perfect buying opportunity. Dollar cost average your way into the market by buying small amounts weekly or monthly all the way down. There are different ways to dollar cost average, but even the most primitive one will do the trick. All in one, during a recession, you should do the opposite of what the majority is doing, and don't try to time the market. However, there will be a market bottom, and when you hear the grandma at the supermarket talking that we will crash further, that everything is doom and gloom, this means that the bottom is most likely already in or very close. Such times of distress represent in fact huge opportunities for your future. Be it by investing in the stock market, real estate, or opening or consolidating a business, you should never waste a recession. In a nutshell, watch your expenses, act now, remain calm, and smash the like button.